Hey there, and welcome. We're about to pull back the curtain on the massive, complex system that moves money all across Canada, the financial marketplace. It's what powers everything from your local coffee shop to massive skyscrapers. And believe me, you're a much bigger part of it than you probably think. So, let's kick things off with a question that might sound a little strange. How on earth does the money you're stashing away for a new car or maybe a vacation end up helping build a brand new hospital? I mean, they seem like totally separate worlds, right? Well, they're not. They're directly connected. And figuring out that connection is the key to understanding our entire economy. You see, at its very core, the whole financial system is built to solve one big problem. It needs to connect the people who have money with the people who need money. That's it. Think of it like a giant nationwide matchmaking service, but for cash. Okay, let's break this down to its absolute basics. On one side, you've got the savers. That could be you, that could be a big company, or even the government if it has a surplus. And on the other side, you have the users, people and organizations that need that money for things like a mortgage, building a factory, or, that hospital we just talked about. The financial marketplace is the bridge, the essential link that brings these two sides together. All right, let's get a little more specific here. This money we keep talking about, it has a more formal name, capital. And you can think of capital as the product that's being bought and sold in this huge marketplace. It is literally the fuel that makes our economic engine run. Right, and here's the key thing to get. Investment capital isn't just cash stuffed under a mattress. Nope, it's savings that have been put to work. It's the money that gets invested into projects, into businesses, into big ideas, all with the goal of creating even more value and, more wealth down the road. And capital kind of has its own personality. I like to think of it as a really picky traveler. First off, it's mobile. It can pack its bags and go anywhere in the world for the best opportunity. It's also really sensitive. It hates risk and instability, so it'll avoid places with chaotic politics or unclear rules. And finally, it's scarce. There's only so much of it to go around, which means it will only travel to places where it feels welcome, safe, and where it expects to get a good return on its investment. So where does all this picky capital come from? Well, it's supplied by three main groups. You've got retail investors. That's just regular folks like you and me. Then you have institutional investors. These are the big players like pension funds or mutual fund companies. And finally, you have foreign investors who look at Canada and see a safe, stable place to put their money. But no matter who it is, just remember, it all begins as simple savings. So to get the money from the savers to the users, the marketplace needs some tools. Think of these tools as the standard packaging for capital. They make it really easy and efficient to buy, sell, and trade. The official name for these tools is financial instruments, and really, they're just contracts. They're the formal, legal documents that spell everything out, what the buyer gets, what the seller promises to do. Having this standard set of rules is what allows the whole system to work so smoothly. And this whole toolkit really boils down to two main instruments. First, you have debt, like a bond. When you buy a bond, you're acting as a lender. It's basically a fancy IOU that promises to pay you back with interest. The other option is equity, like a stock. With a stock, you become an owner. You're buying a small slice of the company, and you get to share in its future profits and growth. So two very different ways to provide that fuel for the economy. Okay, so we've got the fuel, capital, and we have the tools, those financial instruments. But where does all the action happen? Where does the trading actually go down? Well, welcome to the financial markets. Now, this is a really important difference to understand. First, you have the primary market. This is where a company raises new money for the very first time by selling brand new stocks or bonds directly to investors. After that initial sale, those securities live on in the secondary market. This is where investors just trade those existing securities among themselves. The company doesn't get any more cash from these trades. It's kind of like a used car market for investments. And these marketplaces have, let's say, two main flavors. You've got your auction market, like a stock exchange. It's one central hub where all the buy and sell orders come together and compete. The highest price someone is willing to pay meets the lowest price someone is willing to sell for. Then there's the dealer market, which is totally different. It's a huge network of dealers trading directly with each other over computers. There's no physical trading floor. This is often called over-the-counter, and it's how most bonds get traded. So how do you actually get into these markets? I mean, you can't just wander onto the floor of the Toronto Stock Exchange, right? You need a guide, an expert who can get you in the door. In the industry, they call these guides financial intermediaries. Yep, these are the matchmakers we were talking about. Financial intermediaries are the organizations, your banks, your investment dealers, that connect you to the markets. Their whole job is to make the process of moving capital from savers to users as smooth and efficient as possible. And they come in a few varieties. First, there are the deposit takers, like banks and credit unions. They take our deposits and then lend that pooled money out. Then you have the non-deposit takers. Think of insurance companies, which invest the premium payments we all make. Or investment dealers. They're the experts who help us buy and sell stocks and bonds directly on the market. Now, look, a system this big, this important, it can't work without one absolutely critical ingredient: trust. Everyone involved, from the smallest saver to the biggest company, has to believe the game is fair. And that is where regulation comes in. In Canada, we build that trust with a two-layer system. At the top level, you have the provincial governments. Their securities commissions set the big picture rules of the road. But then, they give power to industry bodies known as self-regulatory organizations, or SROs. These groups handle the day-to-day enforcement, making sure their members are following the rules and always acting in the best interests of their clients. And here's a core principle that really shows you what the priority is. If there's ever a conflict between a provincial rule and an SRO rule, the stricter of the two always applies. It's a built-in safety net that is designed first and foremost to protect the investor. And just to give you a sense of the scale and why this is all so important, get this. Over 90% of all banking assets in Canada are controlled by just 6 major banks. That's a huge amount of concentration. It means the health of our entire economy is incredibly reliant on these few key players, which makes having fair and effective rules absolutely critical. Wow, we've covered a lot of ground, haven't we? From savers and users to capital, markets, and rules. But it all comes back to one simple idea. This entire financial marketplace, this vast interconnected system that powers our country, is built on the foundation of individual savings. It all starts with a single dollar. So the real question is, where will yours go?